All right, good afternoon, everyone. My name is Ron Bullis. I'm the CEO and founder of Lifeworks Advisors, coming to you today from Grand Rapids, Michigan, our home office. If you are new to one of our webinars, real quick before we get started and I go through what the agenda looks like today, let's just make sure technology is working okay. If you can hear me all right, look down on the bottom of your screen, whether you're on an iPad, desktop, laptop, mobile device, whatever, and you should see a little set of options and menus. One of those, there's a little smiley face. Go ahead and click that. That is a Giphy, and you can post a reaction. Just give me a thumbs up, hand clap, something to let me know that you can hear me all right. Okay, looks like audio is working. That is one of the best ways. I love getting feedback. I don't have my AirPods in right now, so I'm not going to be taking your questions by turning your audio on until the end of my presentation. But I did leave some space today. This is more of an educational event as opposed to maybe a traditional market update. I did leave some space at the end of this presentation to do a live Q&A, and I'll click your mic on so that we can chat. Well, we're also here. If you look down again at that icon bar at the bottom of your screen, you should see a little call out icon. If you click on that, that will take you to our chat feature. One of the things I'll have up on my screen here in front of me is a live chat feed. So if you have questions while I'm going through the presentation and you want to put something there, I will address it while I'm talking. You can also direct message back and forth to other participants here. Send me a direct message as well. Really excited for today's presentation. It's something that a lot of our advisors have been asking me to do for a while now. This is probably going to be part one. If you haven't been on one of my live streams before, just know I tend to over prepare and bring more information maybe than I can cover in our time together today. But my intention for today's time is to walk through the Lifeworks way of investing, what we call life-driven investing. Why is it that we manage our clients' assets a certain way? How do we do it? Why is it different than traditional risk-based type of programs or other traditional investing that other firms in the industry follow? I plan to cover that. And then I plan to talk about our factor-based investment platform, why we use it, the science and the research behind it. My goal is that you walk away from today's live stream with a really good overview and clarity around how Lifeworks helps our clients plan and manage their investments for the future. At the end of this, again, I'm going to leave time for a Q&A. If you want to ask me any questions, I'll do my best to answer them. And looking forward to that. So for those of you that are just joining, my name again is Ron Bullis. I'm the CEO and founder of Lifeworks Advisors. Really glad to have you here on one of our client live streams today. All right, I'm going to get us kicked off. And if you're also new to this platform, a couple of things that I would also point out here real quick. You can change your screen view simply by, if you hover your icon, if you're on a laptop or desktop, if you hover your icon over top of either the slide deck or my picture and you click on it once, it'll go to a full screen takeover. Click on it twice, it'll drop back where you can see my beautiful face and video alongside of the slide screen. If you're on a mobile device, you can also go picture in picture so you can see it well. I'm trying to set this deck up so there's not a lot of small print, so it's easy to follow along while we're going. Okay. Our agenda today, I'm going to start by unpacking the traditional approaches to investing. I'm going into my 18th year, which seems like a crazy number. I am not that old. I'm going into my 18th year of being a financial advisor, my 8th year as the CEO of Lifeworks. If you're a new client to Lifeworks, couple of things about us that we've started in 2017. We built one of the first, if not the first, membership-based financial planning offerings in the country. We believe at our core that everybody should have a clear, well-thought-out plan that connects their values to their money. And so we built a system that focused on helping our clients do that first. We've had quite rapid growth over the years. It's been really exciting. There's about 50 people at Lifeworks Advisors today, maybe 45. We employ software engineers, quant investors, CPAs, financial advisors, and the likes, all with a goal of helping you connect your life's purpose, your life's work with your money. So I'm going to talk a little about the traditional approach to investing that I've seen in my 18 years, why we designed Lifeworks the way we did, why we believe it is the right way to invest. We're going to break it down into a couple of different pieces then. We're going to talk about what life-driven investing means. I'll talk about the technical pieces of it. what factor-based investing is and why we use it. And then we'll also compare that to the 4 main types of investment selection that gets used in traditional investing, talk a little about pros and cons, and then we'll wrap it up with a Q&A. So again, if you're new to this and just joining me, welcome. My name is Ron Bullis. I'm the CEO and founder of Lifeworks Advisors. Bottom of your screen, you'll find a little smiley face. You can post reactions or Giphies as I'm going. You can also click the call it icon and message directly with me and the group during the presentation. All right, so let's talk about the traditional approach to investing and where I believe the industry has gotten it really wrong. Not any conspiratorial things, not pointing any fingers, but our pedigree as an industry started in the early 1900s, and it was focused on the stock market, selling stocks, stockbrokers. After World War II, the concept of retirement started to come into play, and the creation of financial products started to emerge. And then those financial products that were created by Wall Street were sold by stockbrokers and insurance agents. Jump forward another couple of decades, and you started seeing this kind of intermixing of what they started to call wealth management, financial advice, and stockbrokers. And it hasn't necessarily gotten any less confusing today. But what happened along the way was our industry was always focused on selling some type of product. Even today, a lot of firms out there that talk about being financial planning firms really are doing financial planning because they're trying to sell their investment products. They're trying to sell some type of annuity product or insurance product behind it. So what's happened along the way is the traditional approach to financial planning and investing has come to start asking this question, or some variation or flavor of this question, like how much risk can you tolerate? So if you've ever been part of a 401k plan or you've worked with another advisor outside of Lifeworks, you've probably taken what's called a risk tolerance questionnaire or a risk assessment or a risk score or something like that. Most of the industry is actually based on this premise of trying to ask clients how much risk do they want to have with their investments. I'm going to explain later in my presentation why this is not only like flawed, but it actually leads to really terrible outcomes for clients. Now, Lifeworks asks the question in a much different way. Asking how much risk can you tolerate or how you feel about risk isn't the right question. The right question is, how do you want to live? And then how do we need to invest your assets in order to make that happen? It's a fundamentally different question, and it's at the core philosophical approach to how Lifeworks manages our clients' money. It's the core of our investment platform. All right, so the number one problem with traditional investing and the traditional methods of what I'll call asset allocation, at the heart of it is risk-based investing or risk scoring, risk tolerance questionnaires, right? Give me a thumbs up, hand clap, some kind of reaction if you've ever heard of these classifications before. A conservative investor, I'm a moderate investor, I'm a balanced investor, I have a balanced portfolio, okay? These are classifications that are completely arbitrary because what one person might consider to be conservative, another person might consider to be extremely risky. There are really, really smart people that I like reading their research and I like following that believe Bitcoin, I'm just using an example, not making a recommendation here, but they believe Bitcoin is literally the next best or the greatest asset one could own right now, and it's the future of our monetary system. And they're really smart and they're really intelligent and they're really well thought out and they've got great research around it. And then you've got somebody like Warren Buffett who calls it rat poison. So if you ask somebody who believes in Bitcoin and digital assets and cryptocurrency, if owning a whole bunch of it is considered to be aggressive, they'd be like, no, not owning it's an aggressive position. It's so risky to not own it. And then if you ask somebody who thinks it's rat poison like Warren Buffett, he would say, you have to be out of your mind. That's so aggressive. So why did our industry why does our industry currently use this? Well, it allows us to build, and I'm going to say us because Lifeworks is a part of the system, although we're trying to do it differently. It allows our industry, financial advisors, investment managers, Wall Street, to create products and then to take everything that's unique about an individual, their hopes, dreams, finances, taxes, and everything like that, and reduce it down into a category so that they can align you to a product. It's an efficient distribution system. I build a financial model. right? I build a model portfolio or some type of product. And then we say, look, this is conservative. So everybody who has some kind of conservative investment outlook, this fits them and you can go and sell it to them. It also creates a CYA for financial advisors and firms. An example, when the market goes up by 30% over the last couple of years and a client's investment portfolio only goes up by 5%, and they say to their financial advisor, why is my portfolio only up 5% and the broad equities market is up 30%? The advisor can say, well, you wanted to be conservative, so we have you in low risk things. That's not a wrong answer, but it's a CYA for the advisor, because when the outcome that the client's looking for isn't met, the advisor can point back to the client and say, well, you picked this risk tolerance or you picked this risk assessment. Okay, so I'll get off of this one in a second. I'm going to give a couple more examples here to this. I'm not going to be beating a dead horse, but this is really the entire foundation of how the wealth management industry helps clients invest their assets is generally based on this, some type of risk-based approach to investing. Now let's take another real life example. I used to encounter this all the time when I was at a large national firm. I would have to have a client fill out a risk tolerance questionnaire. And I'd have somebody who's 45 years old, who is very risk adverse, maybe think engineer, teacher, a profession maybe that isn't known for being overly risky, right? And that younger client would fill this out and would come back as a conservative investor. Then I would do the same risk tolerance questionnaire with somebody who is in their 60s getting ready for retirement, and they would come back a conservative investor. Well, this hypothetical but real, because I've personally experienced it and I've seen advisors deal with this thousands and thousands of times. Now this person who's 45, who has 30, 40, 50-year lifespan ahead of them, is investing their assets and their investments in the same way that somebody who's 62 and maybe has a 20 or 30-year timeline, or that 62-year-old who needs to actually start taking distributions from their portfolio where the 45-year-old doesn't for 20 years. It's nonsensical, but it's the foundation for how most investment portfolios are built today. All right, consider this. Here's an example. I actually said this on stage at a large conference in our industry a few years back. I didn't get invited back to speak, but I gave this analogy when talking about how nonsensical it is to build somebody's investment portfolio based off of their feelings towards risk. So here's the analogy. Imagine you're not feeling well, okay? And after a few weeks of not feeling well, you do what most of us would do, maybe with your spouse's urging, right? You call your doctor and you schedule an appointment. So you go to your doctor's office, you explain you're not feeling well, you explain, kind of what's going on, and your doctor probably is going to say, okay, let's run some tests on you and try and figure out what's going on. Now, doctor runs some tests on you, sends you home, calls you back the next week and says, I have some bad news for you. We found in some of your tests that you have cancer. Now just imagine for a moment, after the bad news kind of like hits you, imagine how you'd feel if the doctor took their script pad, right, and handed it to you and said, tell me how you feel about chemotherapy and radiation and how much of it would you like to have? The logical answer by any one of us would be, well, I hate the fact that I have this illness and I don't want any radiation and chemotherapy in me, but if I have to have some of the poison in my system to kill the cancer, I want the least amount of it possible. Now, most of us would run from that doctor because we would have gone to the doctor because we're looking for them to tell us what we need to do in order to achieve the outcome that we want. We're not asking them to talk to us about how we feel about it. Now, this is this is obviously in no way related to investing, but it's the same exact thing when a client would go to a financial advisor or a financial firm and say, I need some help with retirement. I'm worried about my financial future. Can you help me save and plan? And they put a piece of paper in front of them or put them in front of some screen and say, well, tell me how you feel about risk. It's the exact same thing. Problem number 2, and I'm going to go through these pretty quickly. Problem number 2 with traditional investing is the use of model portfolios. So once Wall Street had figured out how to classify people into categories so that they could take everything unique about them and reduce it down from millions and millions and millions of unique variables to 5 categories, right? Conservative, balanced, aggressive, very aggressive, something like this. Once they figured out how to do that, then what they did is they said, well, now let's go build model portfolios, right? These are like the value meals when you go to a fast food restaurant. I don't eat at fast food restaurants, but still see them all the time when I travel. And you're like, I'll have a number 3. Well, you could still order off the menu and you could pick and choose something custom for you, but they put it together in a meal plan. I'll have the number 3, I'll have the 2, I'll have the 7, right? Model portfolios are something similar, but designed by financial firms in Wall Street to package investments into something that's easier to sell. Is there anything wrong with model portfolios? Not necessarily, but in execution for you, the client, there are some problems with it. The first one is this. Here's an arbitrary category problem, right? So I've seen 10,000 plus investment statements from clients from all different institutions in my 18-year career. And I'll generally see something like 10 to 15 different ETFs or mutual funds or holdings inside of someone's investment portfolio. And they'll have US large cap and small cap and international and emerging and down the line, okay? But I'll say to them, right, well, let's use Apple as an example. Is Apple a US large cap stock or an international large cap stock? And while we're playing this game, right, throw it in the chat here real quick. So chat icon at the bottom, a little call out. What do you think the answer to this question is? Is Apple, the company, right, not the food, but is Apple a US large cap stock or an international stock? What do you think? Yeah, both. International, both. If we go through this and we were to ask 10,000 people, we would probably get answers like both or international or US. So one, we might not even have an agreement on it. But the answer to this question is yes, both. I pulled this just through some research this morning. So again, this is by no means an investment recommendation. We'll just make sure that's always there. But I wanted to use this as an illustrative point. Most of the largest companies in the United States that make up the S&P 500, Apple would be in there. It's one of the top 10 largest companies in the world, right? Over half of its revenue comes from outside the United States. So when we're constructing a model portfolio in the traditional sense, like all of Wall Street does, and 95% of all the financial firms out there that serve clients like you, and I build a model portfolio where I'm like, I want to have 20% US large cap and 7% US mid cap and 3% US small cap, and then I want 22% international and I want 15%, that's what happens. But Apple then winds up in which one of those categories, right? So in constructing model portfolios, the framework or steps that usually go through is, and I'm going to just use Wall Street ubiquitously just to kind of talk about the industry, where Wall Street is going to group investments into arbitrary categories, just like I made the example here with Apple, right? Then they're going to select smart people to manage each category of investment. Now, over the last decade, a lot of this has moved from actively managed mutual funds to more passively managed ETFs, although the trend right now is kind of moving back to actively managed ETFs. We'll talk about that later, right? But they group investments into categories, large cap, small cap, mid cap, et cetera, emerging, international. Even though the majority of the S&P 500, which are US-based companies, derive a significant portion of their revenue from the international market, they still will allocate clients' money to this international bucket, right? Then they're going to set some basic rebalancing rules, and they're going to be able to go out there and apply this model portfolio to thousands and thousands and thousands of clients on repeat. That's problem number 2. Problem number 3, the wrong objective. So traditional investing has the wrong objectives. You might have had a conversation like this with an advisor in the past, or you've talked to a friend or coworker who's had a conversation like this. I have witnessed these conversations, but this is a hypothetical, right? Client calls their advisor and says, Mr. or Mrs. Advisor, I see that the equity markets are actually down for the year. How is this going to impact my retirement income or my financial plan? Advisor says, well, let's just focus on the positives, right? Yeah, the market's down 15%, but we're actually outperforming the S&P 500 by 2%. So yeah, the market's down, but you're only down 15. You're down less. Isn't that great news? In fact, what most people don't know is professional money managers managing ETFs and mutual funds and investment portfolios are bonused based on how they outperform a benchmark. So if you're an investment manager at a fund company and you outperform the S&P 500 by 2%, you're likely going to get a gigantic bonus. But when we bring it down to the real world where you and I have to operate, the logical question from the client would be something like, I thought you said we needed a 6% rate of return for my retirement income and my financial plan to be successful. What should I do? So traditional investing and how it's structured, right? Problem, using risk-based approaches to asset allocation. Problem number 2 is model portfolios, essentially grouping everything into arbitrary categories and applying it like grandmother's elixir to people. And then number 3 is the wrong objectives, right? The objective of an investment fund manager is to outperform a benchmark, but that is in no way aligned to your objective that you have with your financial plan. And then multiply it times, millions, tens of millions of people. And it's impossible to think that the objective of somebody managing a model portfolio actually aligns with the objective of the individual client. All right, so traditional focus again is trying to outperform a benchmark. Now, I've talked to thousands and thousands of prospects. I was asked the other day, I was kind of thinking about this. So 18 years of being an advisor, going into my 18th year, let's say on average 1,000 conversations a year, 20 a week. The majority of those conversations, people would ask me, well, how did your investments perform relative to, and then they would pick something, the Dow Jones, the S&P 500, right, a benchmark. And when I was at a large national firm, I used to kind of follow the storyline in the playbook. It always kind of felt a little bit weird, but I'd be like, oh, our investment portfolios are underperforming because of this factor and that factor and et cetera, et cetera, et cetera. And I listen to commentators today doing something similar, right? Putin met with Trump and this happened, and so the markets are going to go down, and so you should sell this and buy this. And there's this incessant desire, I think because of how marketing, Madison Avenue and Wall Street have connected on this, to sell people on the idea that the thing you should be trying to focus on is outperforming a benchmark, and it's nonsensical. What we should be focusing on is achieving specific financial goals for you, having the cash to create the income when you need it, right? So this mismatch of objectives in the real world does create significant differences in outcome. All right, so let's shift gears a little bit here. If anybody has any questions, again, feel free to throw them in the chat. My purpose today was high-level education. I hopefully just set the stage really well with 3 significant foundational problems with the traditional approach to investing. Now, the traditional approach to investing does go hand in hand with how financial planning is approached, because most financial planners, right, take the assumptions from how their investment system is built and they drive those into their client's financial plan. So let's just talk a little bit about Lifeworks here in our life-driven investing. The core principle or the core philosophy of this is that your investment portfolio should maximize the probability of you achieving your goals and your vision for your life. If you need a 4% rate of return consistently every year to generate the income that you need in retirement, and your portfolio goes down 5%, the right question to be asking is, what actions do we need to take to still be on track? What should we be doing to reorient? Winston Churchill is maybe, I think he's attributed with this, my sense is probably his quote, but he's quoted as saying something like this: plans are of little importance, but planning is essential. What he's saying is anybody can have a plan, but life never goes according to plan. And so you constantly have to be iterating through how you're approaching and how you're navigating, right? So when life doesn't go according to plan, how do you adjust and how do you correct and how do you get back on track? So your investments should be centered around the idea of maximizing the probability of you being able to live the life you want, not outperforming the S&P 500. That's a fool's errand. In fact, there's plenty of academic research by people that have won Nobel Prizes in economics and finance showing that trying to outperform the S&P 500 or some benchmark happens at such a low probability and percentage of the time, right? That, again, I would just call it a fool's errand. Okay, so we call this life-driven investing in part because it actually comes from the technical foundation of this. It's called liability-driven investing. Now, when I started Lifeworks and we were rolling out liability-driven investing to try and fix this problem that I saw, right? I would start talking to people about liability-driven investing, and even advisors would be like, I have no clue what that means, right? So technically speaking, liability-driven investing is matching the right type of investment asset to the current or future cash flow need. Asset and liability matching. I'll give you a really clear, hopefully easy to follow example. Let's say 1 month from now, you need to have income from your investments to buy groceries, to pay for your health insurance premium, to pay your mortgage payment. And if I was to say to you, hey, let me have that money and I'm going to go pick whatever you think the riskiest asset could be. I'm going to go buy, stocks. I'm going to go buy options. I'm going to go buy Bitcoin with that. Most of us logically think, wait, hang on. I don't want to do that because I really need to make sure that money's there. I have to buy groceries for my family. I have to pay my mortgage. I have to pay for my bills. I want to put that money somewhere safe where I know it's going to be there. Okay? Asset and liability matching. So your assets are your investment portfolio. Liabilities are the future cash flow needs. So where liability-driven investing comes from is from pension funds, endowments, and insurance companies and institutions like that. It's actually where I learned about it, was from my time at a large national insurance company. By law, statutorily, they had to make sure that their investments match the right liquidity, right? So cash, money market, short-term treasuries, all the way up to illiquid real estate. When they had to make the pension payment or pay the insurance benefit or pay the income out to somebody, the annuity claim out to somebody, they had to match the right type of investment to it. So the closer to the present that we need to spend the money, the more of those dollars should be in things that are liquid and that are safe, that don't have volatility of pricing to them. The farther out into the future, right? So if you said, Ron, I don't need to spend this dollar for 30 years, where should I put it? I would say, well, definitely we should put it somewhere that's going to grow and outpace inflation. So the farther out into the future that we need, that those dollars are going to need to be spent, the more we need to focus on growth so we outpace inflation. But the closer to the present, like buying groceries, paying your utility bills, paying your mortgage next month, or even next year, those should be somewhere where they have very low volatility and a very known outcome. So we framed it as life-driven investing because to calculate what your future cash flow needs are, well, that's financial planning. Whether you're 45 or 65 or 85, we can look at how you're spending your money today. We can talk about the things that you might not want to spend your money on, but you have to, like health insurance or renovating your house, putting a new roof on your house, things like this, what I'm living through right now. We can talk about how you want to spend your money and the things that you need to spend your money on, and we can plan that. That's financial planning. Once we have that picture of your cash flows and your future income needs, now we can look and say, okay, for the dollars that we have to spend in 5 years, how should they be invested today? For the dollars that we have to spend in 10 years, how should they be invested? And this isn't a one and done, because obviously as you move forward in life, you get a little bit older, things change, market goes up, market goes down, right? Taxes, there's a lot of variables. And so this is an ongoing process that we built the technology to help our clients do this. Okay, you can't time the market, but you can time your cash flows. I learned a long time ago that the best investors are people who focus on the things they can control. What they buy, when they buy, how they buy it, when they sell it, how they sell it. They're not focusing on saying, I need to get X rate of return on it, and I'm going to try and outperform, again, a benchmark or something like this. They're also not trying to time the market, right? So core philosophy piece here for life-driven investing is you can't time the market. It's impossible. No one can consistently do it. You can control the timing of your cash flows. Now, I put a little asterisk here because obviously emergencies happen, but good, proper financial planning, right, done with your advisor, we should be able to plan for some of those contingencies, right? Not all of them perfectly, but certainly the majority of them, right? So matching your investment timeline with your spending timeline is what life-driven investing is. So map your cash flows, financial planning, segment your assets, which I'm going to talk about here in a minute, And then matching your investments to the right timeline. The technical term for this is risk budgeting, right? How much risk do we need to take with these assets? Many of you guys have seen this graphic. It's on our website. It's in a lot of our materials. But I just want to kind of cover this again, right? So at Lifeworks, we segment our clients' money into 3 distinct tranches that are time-based, okay? So tranche 1, we've labeled safe. Our focus here is preserving purchasing power, having liquidity for you to pay your immediate needs and your bills, okay? Now, why 3 years? Well, the average length of time, I think I actually have this in a slide here. Let me just see here. Yeah, here we go. This is from the National Bureau of Economic Research. It's something that I follow, although it's kind of boring statistical economic stuff. But this is all of what they would consider to be the recessions or business cycles all the way back to 1854 here in the US, okay? And what I want you to see is if we zero in on this, we have this peak to trough, this first column here, of 17 months. So over the last 170 years, the average length of time from the top of an economic cycle to the bottom, right, measured by economic productivity shrinking, so it could be things like high inflation, stagnant wages, low economic output, et cetera, right, is about 17 months, a year and a half. But to get back to where we started is about 41 months. And that's the second column there. So it's impossible to know whether we should have 4 years or 5 years or 2 years in our safe tranche. But when we look at long-term averages and we set our foundation there, the reason we recommend our clients holding 3 years of their income and spending needs in safer assets is because we know from history that the average length of a recession is somewhere between a year and a half to 41 months, 3.5 years. And the average length of a bear market, which we don't want to be selling our clients investments during, the average length of a bear market in the United States is a little under a year. Okay? So there's some logic that's there. There's some looking at history. But the goal, again, here is to have the liquidity and to plan it out in advance. So we're not selling assets when we don't want to be. We're not forced to liquidate in a down market, or we're not forced to liquidate in a tax situation that isn't favorable for you, the client. Okay, segment number 2, tranche number 2, covers years 4 through 10. Now, this is the hardest time period to invest money for, in my opinion, because the greatest risk that all of us face as long-term investors, the greatest risk, I should actually say it this way, the greatest risk that all of us face as humans, right, as it relates to our financial plans and our money, so not talking medical things, but as it relates to our financial plans and money, the greatest risk we actually face is not the market going up and down. The greatest risk we actually face is that everything we need to live on is going to cost us more every year for the rest of our life. Economists call that inflation. I like to say everything that I need to live on is going to cost me more every year for the rest of my life because it actually brings it home for me. When I say inflation, it's kind of like, consumer price index, wait, everything I need to live on is going to cost me more every year for the rest of my life. That's the greatest risk we face. If you look back at the value of a dollar, right, and whether you want to jump back 20 years, 30 years, 50 years, 100 years, we have been on this steady trajectory where inflation has eroded our purchasing power year over year over year over year over year. So how the government measures it, the CPI, Consumer Price Index, just based on the government's measurement, the value of your dollar is going to get cut in half every 15 years. Now, if you live in the real world, like all of us actually do, right? So that's the joke. We know that when we've gone to the grocery store, the price of eggs, as just an example, has gone up way more than 3% over the last couple of years. And it's unnecessary to get into an argument with anybody, I think, because I get asked this question a lot, or I get emails forwarded to me a lot about this, about tariffs and inflation. Like, it doesn't matter. When we look at the history of the US government for the last 100 years, post the creation of the Federal Reserve, what we see is a nonstop one-way train. Now, there have been some deflationary periods, so like, don't throw stones at me, those of you that are history buffs, but on the whole, the value of our dollar is declining every year. So we know that. which means I don't want to hold a lot of our clients' assets in low yielding bonds and cash instruments. But because it's a shorter term timeline, right, we also don't want to just have all of those assets sitting at risk in the market. So this tranche 2 is a really difficult time frame to invest for because it covers a period of time that's far enough into the future. We want to be very thoughtful about inflation and earning a rate of return to outpace that, but we also need to still be conscious of market volatility. Okay, so we do hedging strategies in here for our clients. Now that interest rates have risen back to somewhat historical norms or averages, owning US Treasuries and high quality fixed income here can be part of the solution, right? All right, tranche 3, I'll move through this. I still got a lot more to cover and I'm looking at my time here, realizing I'm probably not gonna get through it all. Tranche 3, the last segment of our clients' assets. And again, these are not fixed segments, meaning we don't just do this once and then it's set in place forevermore. We're actually updating this every time we're updating your financial plan, okay? So tranche 3 is everything that's 10 plus years into the future. So think year 11 and beyond, right? These are long-term dollars, right? And these should be approached with things that we have a reasonably high confidence are going to generate a real return that's above inflation and compensate us for the risk that we're taking. Equities, real estate, gold, maybe digital assets, private equity, things like this would fit into this type of bucket or this type of tranche. All right, so let's just real quick talk about this, and then I'm going to cover something that's maybe a little bit more boring and tactical, which is factors, which is the other half factor investing of the Lifeworks investment platform. So problem number 1 of the traditional approach to investing is that it's based on risk assessments, which are arbitrary, and take everything unique about an individual and reduce it to a category and then apply a model portfolio or grandmother's elixir to that. Well, you came back a 60, so you should be a 60-40 portfolio. You get 60% bonds and 40%, or 60% equities and 40% bonds, excuse me, right? I'm actually going to pop my whiteboard on here in a second. I'm going to give you an illustration of how this plays real quick before we move on. Problem number 2, model portfolios, one size fits all. One size fits all, the value meal approach makes for easy shopping and makes for easy distribution, makes for easier sales, but it doesn't lead to better outcomes for clients, right? And the last one is focusing on the wrong objectives, which I covered too, right? All right, so I'm going to switch screens here a second. I'm going to walk through a real life, I'm going to say real life. I'm going to walk through a hypothetical example. And I just find this easy to draw out and talk through. So while I'm getting my whiteboard kind of queued up here, if you have some questions that have been going along, feel free to toss them my way. Just changing a couple things here. All right, hopefully everybody can see my little chicken scratchings here. So before I get too far into this, all right, great. So before I get too far into this, what we're looking at here is annual average returns, the geometric returns, by the way, not just an arithmetic mean, but the geometric average. And I'm using the corporate bond, investment grade bonds, and then the S&P 500 as proxies. Now I pulled this from Damodaran's research site. He's a business and finance professor at NYU. He's widely cited for his data. Happy to send anybody a link if you want to get it and validate it. But this is just looking at annual returns on a year-by-year basis, all the way back to 1928. And what I just did here is I grabbed 10-year, 20-year, and 30-year averages. And I want to just highlight something here a second, right? When we are looking at the 10-year average for bonds, we're looking at about 3.4% rate of return. When we're looking at the 10-year for the S&P 500, we're almost 13. So here's how this plays out a second. Here's what I want you to be conscious of. So I talked about how the industry uses risk tolerances or categories to determine how a person's assets should be invested. One of the most common ones that we see is to set up something like this. So we have an individual that's 65 years old. They have 1.5 million of investments. They need $60,000 of income from their portfolio for retirement, and they currently have a 60-40 asset allocation. Everybody tracking so far? Thumbs up or throw me something in the chat so I can make sure everybody's seeing this okay. I know I've got a little bit of hieroglyphics for writing. Okay. So this is very common scenario that we see. Okay. Let's just break down what this actually means in practice then for this client. Okay. So let's just say that we have years here, and we have their income need here. So we're going to use 1, 2, 3, 4, 5. Actually, let's do this. We'll go 5, and then we're going to jump to 10. Okay. I just want to illustrate how this works. And we know in year 1 they need $60,000, and let's just say there's 3% inflation, so that means next year they need something like this, and then right, it's going to keep going down. Okay. Everybody tracking with me so far? Make sense? Give me a thumbs up, hit your little reaction thing. Want to make sure, blink once for yes, twice for no. Okay. If somebody in this situation has a 60-40 portfolio, right? What that means is they have about $900,000 in equities, okay, and $600,000 in bonds. Now, I'm not beating this up at all. So again, don't throw stones here. I just want to show how this turns into how this turns into less desirable outcomes. Okay. $60,000 a year. This person now has, right, 10 years. If this is their income need, they have 10 years of their income need sitting in bonds. Okay. Well, we can look at the last 10-year return and see that bonds have been 3.44%, and the S&P 500 has been almost 13. Jump back in your brain with me like 5 minutes ago when I talked about the average duration of a recession in the United States and the average length of time of a bear market. Average length of a bear market in the United States is about a year. Now, the outlier here is the Great Depression, right? That was almost 9 years. Okay. But absent of the Great Depression, even if we look back at 07, 08, 09, the Great Recession, right? From the top of the market to the bottom market was about a year, a little over a year. And then back to recovery was another year. So that was like 2+ year time period. Okay. So somebody who's following a risk tolerance asset allocation, right? A very traditional 60-40 or something like this, has 10 years of their income need in an investment that's generating 3.4%. And if we thought about it based off of a more technically correct approach to asset allocation using liability-driven investing, or what we call life-driven investing at Lifeworks, that person would have 3 years. So tranche 1 was years 1 through 3. I'm going to call this T1. Okay. Well, they would then wind up with something like $180,000. I'm going to ignore inflation here just so I don't have to do more difficult math off my head on camera. Everybody's recording me. So in the Lifeworks system, this person might have $180,000 of fixed income, cash and fixed income, right? Well, we know that the way to generate better returns over time for somebody is actually not trying to beat the market or trying to outperform the market. The way to generate a better overall rate of return for the client is to allocate their assets based off of when they need to spend the money. So this client at Lifeworks would have $180,000 of fixed income. The traditional advisor maybe that they were working with, or maybe they were doing it on their own and following, some online advice or something like this, they have 3 times that much allocated to fixed income. So we don't have to be genius mathematicians. In fact, we don't even have to do the math, right? Even a 1% difference in rate of return of somebody's investment portfolio over their lifetime adds up to a lot of money. Okay, now let's actually reverse this scenario. Does this make sense? Everybody give me thumbs up. You don't have to necessarily agree with the math, give me thumbs up. I just want to make sure that the logic of it, that how I'm explaining it tracks, makes sense, people are following it through. I just got to make this that it's a little bit easier. I'm going to set it on auto track. I just realized you guys wasn't auto tracking my, there we go. Now it's auto tracking. There we go. So let's just reverse this a moment, okay? Let's say that this person shows up and has a aggressive portfolio because they worked with their advisor and their advisor said, well, you should have an aggressive portfolio. And so they have 80% in equities and 20% in fixed income. Okay, let's just do this a second here. So if they have 80% in equities, they're going to have 1.2 million in equities. They're going to have 300,000 in bonds. But let's change the scenario, and this is why it's really important to not use risk tolerance questionnaires and generic rules of thumb, because what if this person needs $80,000 of income from their portfolio, right? Well, now they have about 2.5 years, or excuse me, 3.5 years of fixed income. Now, 3.5 years would probably still be okay in this scenario, but as often as we see somebody showing up that's working with a traditional advisor that has far more bonds than they actually need, and they're reducing their rate of return, they're losing to inflation. That's essentially what happens. When you over allocate to bonds, you're going to lose to inflation, okay? And maybe not exactly 50-50, but almost a high enough percentage that it warrants talking about is we'll see clients show up that start working with our firm and they're spending far more money out of their investment portfolio than what's actually sustainable. And they're banking on the market delivering 10% rates of return with no downside. In fact, probably the last 10 or 15 years of the US equity markets has got most investors overly comfortable with risk. Think back to COVID, what happened? The Federal Reserve printed $5 trillion, bailed out foreign governments, bailed out lots, just threw money everywhere. Now, I'm not trying to go back and use hindsight and judge them, but what I am saying is they bailed out the markets, and maybe for those of us that have financial assets, they actually saved the market from collapsing. So let's set aside whether the judgment of what they did was good or bad from an economics perspective. That's not it. But the Federal Reserve of the last decade and a half, and maybe even back to the Great Recession, has essentially propped up the market and kept it from having significant downturns. Now, this is something that I don't believe can happen to perpetuity, and there's other people way smarter than me that have been talking about how this might not be able to be done again by the Fed for lots of different reasons, right? So following an investment methodology that uses risk scores or rules of thumb or something like that for how to allocate your assets and not your actual life, your actual financial plan is extremely dangerous. On one side, you're probably reducing your rate of return because you're over allocating to fixed income, which means you're likely to lose to inflation, which is the real risk. On the other side, if you're just expecting the equity markets to continue their upwardly march at 10% a year and there's never going to be a down market and there's never going to be a recession, and you don't have to have the right volatility and the right liquidity instruments for when you need the cash, you're probably going to get absolutely sucker punched in the face. Okay. Somebody asked if Steve has a question. If somebody does have a question, just post it in the chat. I'm going to flip over to Q&A here in like 5 more minutes. I'm going to go through the last part of my presentation here pretty quick. And back to my deck here. All right. So there's 4 main types of investing. I'm going to go through this really fast. As I said, I probably overly prepared here. So if you guys want, I'll schedule a second one of these and I'll go through this next part in more detail in the next webinar. But there's four main types of investment selection. So what we just covered in the first half of my presentation, the first 3/4 of my presentation, was how you should be allocating your assets, meaning how much should be in cash versus fixed income versus equities, things like this, right? Broad asset allocation. We believe it should be done based on when you need to spend the money, life-driven investing. How you then determine what stocks to pick or what ETFs to pick or the things that you should own inside of the investment, right, account, there's really four main types or four main ways of doing that. The first was called fundamental investing. I want you to think of Warren Buffett, right? He would be a very famous value investor that follows fundamental investing principles. Fundamental investing is having smart people that look at the finances and listen to the investor meetings and read quarterly filings and look at economics and taking all this data and then say, based on all this, I think this company is a good company to invest in and we should own it. That's active management, fundamental investing, very big part of our industry still. Another one is technical analysis. These are people that I would just by shorthand call charters, right? These are people that are looking at the charts, right, of say the returns or the volatility or money movement, whatever they are. They're looking at charts and then they're saying, oh, based on this pattern in the chart, we should be buying or selling this. Okay. Third, which is becoming more and more and more common, especially in retirement accounts with retail investors, is passive investing. And in theory, I'm more aligned and Lifeworks is more aligned with the concept of passive investing because we know by looking at the research, we know that it's empirically true that outperforming a benchmark over time is a fool's errand and nobody does it. I shouldn't say nobody. Very, very, very few people have achieved it. Okay. So passive investing is better in this regard because it removes the tendency we have as human beings to think that we know something, right? Or to get suckered into the next greatest investment, right? FOMO, MOMO, et cetera, fear of missing out. But it has some problems. I'll talk about what some of the problems with passive investing are just really briefly. And then there's factor-based investing. Factor-based investing is how Lifeworks follows it. It's very similar and it's a relatively distant cousin to passive investing, but factors are unique characteristics that have been identified through academic and scientific research to show that they are the predictors of incremental or increased returns. Okay, and I'll explain that in a second here, what that means. So on the passive investing side, real quick, one of the challenges with passive investing right now that just should be called out. I covered this on a webinar a few months back. 40% of the S&P 500, 40% of the value of the S&P 500 resides in 10 companies. So there's something with passive investing now that doesn't get talked about enough, but really should, which is concentration risk. When we own the S&P 500, let's say as a passive investor, the idea, the core principle is that we're diversified across 500 different stocks. But the reality is we're going up or down based on the performance of 10. In fact, if you take the returns of the 10 largest stocks in the S&P 500 out of the S&P 500, most of the S&P 500 has had virtually no return or very low returns for a while now. So passive investing is starting to have more and more challenges as we're seeing really significant concentrations of value inside of a small group of companies. All right, move to factor investing real quick because I've got to cover a bunch of this and I'm actually only going to get through a couple slides. I'm going to take some Q&A here. So what are investment factors? Factors are the fundamental drivers of investment returns. You can also think of it as a method or a system of filtering or ranking stocks. So academic research, people that have won Nobel Prizes for this, have looked at the returns of thousands and thousands of stocks over long periods of time, and then they've drilled down to, right, they basically quieted all the noise and they've said, well, what does the size of a company say about its long-term return? What about the profitability? This is what I call the duh one. By the way, companies that are profitable, that have higher profit margins and have higher payout ratios, right, tend to perform better over time than companies that have less profits. I call this the duh one. However, we've lived in an era for the last decade and a half, maybe 2 decades, where we have these tech companies that have literally lost billions and billions of dollars and burned through so much cash to finally get to a stage of profitability, right? And some of those companies have been the ones that have had some of the highest rates of return, even though they've been very unprofitable. However, they're turning now. So think Apple, think Amazon, right? These companies now have dominant market shares. They're insanely profitable. They're printing cash. profitable companies tend to have higher rates of return over time than unprofitable companies. So the smaller companies in the publicly traded space actually tend to have a higher rate of return over time than large companies. Momentum would be another factor. Momentum is just looking at the recent performance, right, of a stock, and a stock that has had higher performance recently is more likely to continue that upward momentum or that trajectory than a company that hasn't. So these are just three examples. At Lifeworks, we actually use a number of factors. We have two kind of buckets or segments. One is called quality factors, and these are looking at things that would generate stocks or rank stocks by their financial profitability, their financial stability, their dividend payout ratio, their return on investments, return on equity, low volatility. So think like Walmart, Coca-Cola, Johnson & Johnson, maybe large companies that have higher dividend rates that are very consistently profitable. Those would kind of fit up in the quality factor side. Opportunity factors would be looking at innovation, right? Technologically based ones, AI investments, R&D, momentum, et cetera. So why do we use factors at Lifeworks for our investment selections? Well, I only put one reason on here, but I'm going to give a couple and then I'm going to stop. We'll go to Q&A. Number one is academic research is clear that there are factors that can be identified that show or that drive long-term returns more reliably than trying to pick individual stocks or trying to pick individual segments of a market. Now, this would go to my second reason for it, which I've said this on webinars before, and I'll say it again. I don't want your life and the success of your financial plan to be contingent upon a room full of smart people. Now, your advisor's probably smart. In fact, most of our advisors here at Lifeworks, well past me, the really bright group of people. But we operate as a team here at Lifeworks. So you have an advisor, but that advisor's probably introduced you to other people on our team. Why? Well, if we followed the traditional approach to investing, which is reliant on a person or a room full of smart people reading all these reports and looking at all this data and listening to CNBC and doing all this and then going, aha, I got it. We should invest in, right? And pick a stock. I'm making an overly kind of gregarious example here out of it, but that's essentially when we boil it all down. It's a room full of smart people looking at data, saying, based off of our expectations of the S&P 500 or Trump's tariffs, like we should be in this segment. Bloomberg TV, CNBC, like you can turn these news channels on, and this is what they do all day long. They yap about this. Here's the thing. They're wrong like 95% of the time. On the best day, they got a 50-50 of being right. I don't want your life and the money that you've worked so hard for to be invested and the success of that to be predicated upon a room full of smart people. Now, there are smart people at Lifeworks and outside of Lifeworks that we partner with some of the largest names in the industry. So State Street, BlackRock, et cetera. Like we've worked with them to build custom investment strategies using factors that we can then implement algorithmically, right? Meaning we can use this without human bias and without having to have a smart person in the room to help identify the right investments for our clients, right? And that's whether it's your advisor or me or like anybody on the team. We want to make sure that we're serving you and we're helping you invest the right way so you can live the life you want. And it's not contingent upon one of us being here. Now, I hope we're all here for a long time. And I hope everybody, I hope our advisors have long tenures here. And I hope you're a client for decades. We love serving our clients. But reducing the risk to you, helping you invest your assets for the right way, building an investment strategy for you that's custom based on your financial needs, that's core for Lifeworks. So instead of calling it liability-driven investing, which is very technical, and even inside of our industry, a lot of advisors don't know what I mean when I say that, we've just started using the terminology life-driven investing. How you want to live your life and how you need to spend your money to support that should be the basis and the framework for how your assets are allocated. And then we're going to use the best academic research and science, provable math for how we're helping select the investments that go in your portfolio. All right. Thank you for listening. for the last hour. I hope you found it informative. I had 20 more slides and a few more whiteboards to get to, but I plan on doing these more broad-based educational streams for our clients over the next few months here. So watch your email inbox for those. Love to hear feedback from you. Feel free to send something to your advisor if you found this to be useful. If you'd like me to do more of them, I've got ones on how we do planning. I've got a business series coming up. It might not be towards the end of the year, but if you know somebody who's a business owner, entrepreneur, I'm going to share how financial planning should be done for business owners and family business. Okay, I'm going to set it so that you can kick your microphone on. Give me just a second here to change a setting. And if you would like to, you are more than welcome to turn your microphone on. And the way you would do that, the bottom of your screen again, you should see a little microphone icon. If you click that, you can unmute yourself, and happy to take your questions. I also have my chat window up here. So if you find it easier to chat your question, feel free to do that as well. Got to put my headset on as I think about it so that I can actually hear you if you turn your mics on.
Yeah. Hey, Ron. I think I'm already one of your clients, and I'm also with Phil Teltner.
Yes. Yeah. Absolutely. Yep. Phil's one of our advisors.
Yeah, Phil's been my advisor, a planner for 5-6 years already, and so applying your methods, and I've been quite pleased. Moved into retirement now, and I'm disabled. So now I was in the putting away, and now I'm in the pulling away. I just appreciate how your methods have been training me and my needs
Awesome.
as a client. So when you were speaking, I wanted to personally thank you and your company.
Well, I appreciate that. I get to oftentimes have the privilege of being the face of Lifeworks. So I always say this with genuine gratitude and meaning it from all of our team here. We love what we do. We love serving you guys and helping you make wise decisions with your money and how you're living your life. So yeah, thank you for being a client. Thank you for sharing that. That means a lot.
Thanks.
All right. Any other questions? Chris has a question for us. What are your thoughts on alternative investments, private equity, private credit, et cetera, et cetera, et cetera? Yeah, this is a question our advisors get a lot. I have pretty strong opinions on it. I think Wall Street has a history of, after they've kind of sold something enough that people feel like it's not the new thing anymore or it's well understood, they come out with the next thing. And so the last couple of years, what our industry has been talking about is private equity and private credit markets being the next place that we need to figure out a way to make it possible for the average consumer to invest in. The reality is, for most of us, private equity and private credit is not a place we should be playing. Not just because it's higher risk, but there is layers and layers of opacity and fees that go into this. And so if you have expertise, let's say you were in a specific industry and you retired from that industry really well, and you know it like the back of your hand, and you find a private equity group or a private credit markets group that deals specifically in that industry, and you have a lot of domain knowledge and a lot of industry specific knowledge to that, then maybe that would make sense for you to apportion some of your money there, right? But just blindly, or broadly, not blindly, but broadly talking about private equity and private credit markets, my feeling on this is generally by the time it reaches the retail us, right? There's already been general partners and limited partners and attorneys and things like this that are charging a fee along the way or part of the income distribution or preferred payout, so the returns get pretty watered down. Now, there are gurus out there that would tell me I'm an idiot that have written and sold millions and millions of books selling that product, but call me maybe old-fashioned. I look at the public traded equity space, real estate, U.S. treasuries, and for the most part, I have yet to see a client who those types of well-known, highly liquid, a lot of regulation and visibility on how those investments, I haven't found a client who those investments aren't able to satisfy their investment objectives that they need to meet their financial plan and live the life they want. So just as I kind of said, conservative, aggressive, risk assessments, some people might say private equity is risky. People that are in private equity might say it's not risky at all. We know the game, we play the game. But for most clients, my experience of the last 18 years is that they don't need to have alternative investments or high risk type of things or private equity or hedge fund exposure in order to meet their financial objectives. In fact, if you look at the hedge fund index, for instance, you can Google this. A lot of the hedge funds, right, run by some of the best traders in the world, have actually underperformed the S&P 500 over the last 10 and 20 years. So I don't think there's anything wrong with it. I think private equity, private credit plays a very important part of the financial ecosystem in terms of providing access to capital and liquidity to businesses. I just don't see the average American retirement investor needing to allocate money there in order to achieve their financial plan. So if you do, I would be very cautious and I would make it a very small portion. So how I would size that would be very, very small, maybe sub 2 or 3% of my portfolio, if I really believe that I needed to be there to generate additional returns. David, I asked this question 6 months ago. Will we ever be able to see which investments are in each tranche? I hope so. We are feverishly working on, and we were supposed to have a release in February that got postponed and delayed for some technical things that's supposed to be coming in mid-October that will bring visibility to both the clients and the advisor conversation around how your portfolios are constructed and what investments sit in what tranche. So this is a common request. It is definitely something that our team has shared, kind of this frustration. Being a small privately held company, we always end up having to make choices around where we're investing our capital. And this has just been something that's been on our roadmap from our software engineering team for some time, but we've had other things that have kind of come up along the way that we've had to do from a regulatory perspective or an operations perspective. So stay patient. Your advisor could create a report for you. It's a little bit more manual for us to do that, but we could create a report that would show you which investments are by which tranche. But hopefully here before too long, you'll be able to see it inside of our application. Great questions, by the way.
Hello?
Yes.
Yes, this is Jeff Stibey. I'm a client of Chris Gervant and Chris and Renee, who I affectionately call CCR. My question is, where does real estate fit in our portfolios? Is it an alternative investment?
Great question.
I used to flip houses, and I have some real estate investments, but it's more, passive.
Yeah. So before I answer the question, can you break it down for me a little bit? Are you talking like single family or residential type of real estate that's being held for like rental income? Or are we talking commercial real estate like strip malls, office buildings, things like that, or is there a specific one?
I'm in both, but I guess I was thinking more the commercial. I have a
Got
couple
it.
of investments where as a group, we bought into an apartment building.
Yeah, awesome. So I'm actually a big fan of high density residential apartment buildings as an investment class. Um, they're harder to offer, right? It's a smaller market, so they're not necessarily easy for people to get in and out of. But let's just talk about real estate. Real estate to me, when I think about our liability driven investment methodology, it sits in tranche 3, right? Unless
Correct.
somebody has something and they're literally like, I've got a purchase offer, and as long as I buy this, I can sell it tomorrow. Like, unless it's some real short-term flip, which even people trying to flip real estate shouldn't probably be thinking about this way. But in my mind, real estate is a long-term illiquid investment that historically has driven rates of return that are well in excess of inflation and have generated real wealth for people. Now, real estate in the broader sense across the United States actually is fairly correlated to our public equities market. Now, there's pockets, right? So Grand Rapids, Michigan, where I'm from and where I'm standing right now, very conservative area of the Midwest, kind of boring in terms of our real estate values. We don't get double-digit increases. We're not Nashville. We're not Austin. We're not, Miami, right? But we also don't get double-digit decreases, right? We kind of have this slow, steady nature of capital appreciation, 3-4% a year, and then an income payout. So I think real estate privately held, right, where you actually like invest specifically in a piece of real estate that you can taste, touch, and see, I think can be a really great wealth building opportunity. It would sit in tranche 3. I don't consider it to be an alternative investment. To me, alternatives, when that term gets used, are things like digital assets, currency swaps, direct currency investments, art, right? Things like that are really, I'm going to use the word fringe, not meaning they're like weird, but they're really not as widely used as part of a wealth building investment approach. I think real estate is a core, right? Most of us on this, live stream and most of our clients own real estate. Some of it's just personal and secondary residence use, but a lot of our clients have some portion of their personal assets invested in investment real estate. So COVID was a little hard for office space from a commercial space perspective. And retail is obviously challenged in the days of, Amazon and DoorDash and deliver stuff to you. But I think that, a well-structured commercial real estate or high density, like an apartment complex, can be a really great long-term wealth building opportunity if managed correctly. So.
Sounds good. Thank you.
Yeah. Okay, so Trevor has a question. Trevor's one of our lead advisors, partner advisors here. His question was, Ron, could you speak to the clients, prospects of ours that believe in our life-driven investment methodology and matching their asset allocation to their cash needs, but they choose to do it on their own? Why setting up their own passive buckets of safe income growth on their own is difficult to manage over the course of retirement. Yeah, I think, Trevor, I'm happy to take a stab at this. I'm going to make an analogy. Maybe it's crude, but this is how I kind of parse it in my head. Most of us have probably heard of something like Planet Fitness, right? And if you've driven on any kind of like retail-based shopping area, I'm sure there's some kind of 24-hour fitness gym in your neighborhood, right? I just drove by Planet Fitness today and they were advertising $1 down for your first month, right? So if we analogize this to working out and being healthy, okay? If you have the means to drive to Planet Fitness, and if you have the motivation, and if you have the discipline, you could go to Planet Fitness and for $1 a month, right, you could get in shape, right? Then you have more high-end, let's say, private gyms, country clubs, things like this. So maybe like an Orange Theory, a Peloton local studio, right? Pilates, et cetera, et cetera. And that maybe costs a couple $100 a month, but you have a little bit more structure, a little bit more system, maybe a little bit more personalized attention, right? And then you go all the way to hiring a personal trainer, right? What I would say first and foremost is if you're doing it yourself and you're following our life-driven investing methodology, you're on the right path. at some point in time, what our clients have said to us, and most of our clients were successful in their careers, were bright, they were savvy, they were disciplined and safe retirement. What a lot of them have told me over my 18 years is, I actually want to find somebody that I trust to help me navigate this because I don't know everything. And or this is what usually comes, I want to actually enjoy my retirement. I don't want to be focusing on doing this. But I have had a lot of conversations with people that are like, hey, I'm retired. I have a ton of time on my hands. I love finance. I love kind of dealing with this stuff. That's why we built Lifeworks with our membership model. You can hire us to have help with your planning, advice, and guidance, and you could manage your money on your own. Definitely follow our life-driven investing methodology, right? And if you have the discipline and you stick to the system, you can do it. We probably have a few more tools at our disposal as the personal trainers in this analogy, right? Where we might drive slightly better outcomes or slightly better tax management of the investments. But by no means don't mishear me and think that the only way and the only path to success is having us manage your investments. I think it's a continuum of how people want to approach it. Just know that over time, what I've experienced is people move through the stages of their life, they actually don't want to be responsible. And something of serious conversation is, unfortunately, the rise of dementia and Alzheimer's and different things like this that hits people in their older age of their life. They don't know that they're not as sharp as they used to be until it's too late. So it can be really wise to find an advisor that you trust to help you start managing your investments sooner rather than later, right? Just to ensure that there's continuity of the planning, that there's continuity of the discipline, right? Regardless of kind of life circumstances for you. So Trevor, I hope that answers your question. I would think of it as a continuum, right? So, all right, I can take maybe one or two more questions. I got to jump off at about 4:25 because I do have another live stream that I have to do. So if there's a couple more questions, happy to tackle them before we sign off for the day. And if you have to jump, I just want to say I appreciate you being here. As I said before, we love serving you, and your families plan to have the opportunity to do it for a long time if you'll have us. All right. Any last questions, comments, thoughts?
Comment from Jeff Spidey. I'm glad I found you guys. I've been very pleased, and I tell all my friends.
Awesome. Awesome. We love it. We absolutely love it.
Ron, this is Mark in Ohio. Can you hear me?
Good afternoon. Yep, I got you, Mark.
This is way off topic, but I've been watching Maria Bartiromo's The Enemy Above, and I have growing concerns about China investments.
Okay.
What steps, if any, is Lifeworks taking to keep investments ex-China, or is the country of investment a factor that Lifeworks may consider?
So the country is a factor for sure. So I used to get asked all the time and challenged by people in our industry because the core of our equity strategies, which not every advisor applies perfectly to every client because they're empowered by our advisors are empowered to still build custom solutions on top of some of the core things we built for their clients. But the core of our equity investment strategies focus on the S&P 500 stocks only, US-based stocks, okay? Part of that is geopolitical reasons, right? So the China-US tension would be a good example here, right? If we own a company like Apple, right, who has a significant portion of their revenue and their manufacturing facilities in China, right, we're not going to be able to avoid exposure to China perfectly. But if we're at least dealing with the US legal system and the US capital markets in terms of how we're owning it, we have some heads up there. So at a really high level, my answer here is yes, we've been very thoughtful about saying, look, if you look back at 100+ years of data on equity returns, the US equity markets have outperformed every other market in the world except for one, which was South Africa. Okay. And none of us are going to all pick up our money tomorrow and run to South Africa and use their equity markets today. So the US, albeit challenges that we have, growing debt load, aging economy, or aging like age base, birth rates. We have the same problems Western civilization has around the country. We're still way better off and a better place to invest. Now let's talk specific about country-specific risk. The world order as it sits currently from a banking system is so intertwined that when China gets a cold, we get the flu, and Europe has COVID, and it all happens in 24 hours. Meaning, I'll use Apple again just as a proxy for this, right? Most of the goods and materials that we live on and use here in the United States touch China in some way or fashion. And their buying of our US debt for trade purposes, some people think it's nefarious. Like it's really not. The way you actually, if you're a foreign country and you want to sell or buy goods in the US, you have to generally participate in the US Treasury market because you have to post that as collateral to get dollars from the Federal Reserve. But we'll save how the euro, dollar, and the world banking system works for another live stream. I don't know that there's anything you and I can do outside of getting off the grid to avoid interaction with China. Just practically speaking, Amazon, intertwined. Most of the electronic and consumer goods intertwined. Yeah. Our largest publicly traded companies intertwined. Farmland in the United States. I think we need to separate in our minds geopolitical superpowers warring behind the scenes, right, with how we're investing our money, right? So I think it's good to be very thoughtful and research and read those things. I took a very long, dark rabbit trail studying the Federal Reserve in 2018, 2019, and the euro dollar and euro bonds and what that means. And my team at the time, laughed because they're like, Ron's going to go the off-grid God, gold, and guns investment route, right? That's the end of the story. And I didn't. What I came back with is I said, look, there's no such thing maybe even of truly going off-grid. And I don't just mean living in a cabin in the world. I just mean getting outside of the U.S. financial institutions and are intertwining with China and et cetera, et cetera. I think it's almost impossible to do. So we just have to understand the rules, right? And I think, first of all, not getting exposed to international assets that are domiciled outside the United States, right? So why we tend not to hold direct equities that are international or even ETFs or funds that are international is because those are outside of the US legal system. So even though they touch our financial system and the SEC has some regulation oversight, China could snap their fingers and nationalize an entire business. Hey, it happened, right? Not to a US based one, but to Chinese ones, right? Mm-hmm. So there's a few things I think about that we can probably do at the highest structural levels, but I think Pandora's box been opened. We live in a fully globalized banking system, and the interreliance between countries on that, which is why there's people that are, I'll call them Bitcoin maximalists, that truly believe Bitcoin will become the new world order currency, right? This is not conspiratorial. This is just really bright investment people kind of looking at these dislocations, right, around the world. So long answer to your question. I wish I had more time to go back and forth with you on it. Do research, stay informed, know kind of what's going on. I think it's very, very important. An informed populace is one of the greatest ways of staving off bad actors at the state level. But I don't think from an investment perspective, there's any way to potentially hedge against China per se.
Thank you, Ron. Enjoyed your session
welcome.
Today, just like all of your essays and all of your previous sessions. Thank you very much.
You're welcome. Glad you're here. All right. Well, with that awesome question, sorry I maybe opined too long about the China thing. I am reminded that it would be fun and very educational to have a conversation about the banking system and currencies and the geopolitical use of debt, given that we're pushing 40 trillion. Maybe it does make sense for us to have a live stream on that. So anyway, from all of us here at Lifeworks, thank you for being a client. We love serving you and your families. Our mission is to help you connect meaning and money, live an intentional life, and we welcome feedback. We love working with you. Thanks for being here today. I think a recording of this session will be available in the next few days. Probably will get emailed out as a link. So if you want to watch it again or share it with friends and family, please do. But until next time, God bless. Have a great rest of your week, and we'll see you soon.